You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome, everyone. Today we're looking at some pretty major shifts shaking up the tech world. We've got some fascinating stories and insights here. Really compelling stuff about how talent's being valued now, where the money's actually going, and maybe, most interestingly, how software itself seems to be, well, changing shape.
Yeah, it's definitely a critical moment. Things are moving so fast,
Yeah.
it really forces us to rethink a lot of the old strategies and business models. What worked last year might just not cut it anymore.
Totally. Okay, let's start with this kind of weird situation involving Windsurf, OpenAI, and Google. So OpenAI had this huge deal, like $3 billion to buy Windsurf, this coding startup, and then poof, it collapsed.
Right, but then Google jumps in,
Mm.
and they don't buy the company, but they hire the CEO, the top researchers, for $2.4 billion.
Yeah.
And they license the tech.
Exactly. It's being called a reverse-acquihire, a way for the big players maybe to get the talent and the tech, but sort of dodge the usual regulatory headaches.
And the knock-on effect is pretty serious, for AI startups. Losing your key people like that, a massive blow. Hard to keep momentum going after that. And this ties into the bigger money picture, right? AI just vacuumed up VC money in 2024. We're talking half of all deals, and like 61% of the big money, the mega deals.
Wow.
Yeah, and valuations are often double their non-AI peers, especially later on.
But, okay, for everyone else, like the non-AI tech companies, it sounds like a completely different reality. The average Series A company I read now needs something like $2.5 million in revenue, which is way up, like 75% from just a few years ago.
That's right. And even then, growth has kind of cooled off, hasn't it? Down to maybe 70% annually.
So more revenue needed, slower growth overall.
Yeah, and it connects to this liquidity crunch we keep hearing about. Only 7 tech IPOs last year. 7. And you've got, 640 unicorns still stuck, basically private, and maybe only a quarter of them even look ready for an IPO on paper.
So, for you listening, if you're not an AI, this isn't just numbers. It means you got to rethink fundraising, valuation, probably hiring too. The old playbook is pretty much out the window.
Absolutely. The market's clearly split.
Okay, so AI is reshaping funding, talent, but it's also changing software itself. Let's talk about this SaaS 2.0 idea. Traditional SaaS, like Salesforce, right? It's basically an expert's playbook turned into code. Sales best practices codified. But with AI, maybe you don't need the playbook encoded in the app quite the same way. The AI is the expert. It just manages the data directly. Like there's a new dating app example where the AI is the matchmaker, handling all the compatibility data itself. It's less an app, more an AI specialist.
Which totally messes with pricing, doesn't it? That old seat-based model. It just feels outdated now, especially when AI APIs cost real money to run. So usage-based or maybe hybrid models seem like the way forward. Customers expect it, and the cost structure kind of demands it.
Right, but moving to usage-based pricing, like that sounds complicated. How do companies even start?
Well, some folks, like Metronome, who build tools for this, they lay out some steps. It starts, interestingly, with appointing someone, maybe a chief alignment officer, someone whose whole job is making sure the entire company gets how customers use the product and where they find value. It's a mindset shift, not just billing.
Okay, alignment first. Then what?
Then you got to nail the value metric. What are you actually charging for? Then test it carefully, roll it out slowly, and crucially, over-communicate. Talk to your customers constantly through the change.
Makes sense. Let's look at a real-world case like Lovable. This company, wow, $75 million ARR in just 7 months. That's wild. They let non-technical people build apps just by typing in English. Kind of pitched as Shopify for SaaS.
Yeah, incredible growth.
Yeah.
But the pricing, that's the tricky part. They charge based on AI credits used, right? But most of that usage happens up front when someone's building their minimum viable product, their MVP.
So usage drops off after the app is built.
Exactly. And here's the kicker. If the MVP is successful, what happens? The founder often wants to move it to, real code, so they churn. Lovable wants to be the platform like Shopify, but they're pricing it like a one-time construction tool.
Ouch. That's a tough lesson. You build something great, people use it to launch, and then they leave because they succeeded.
It really highlights how tricky this shift is. It's not just flicking a switch on billing. You have to fundamentally rethink value and how your product delivers it over time, even if it means losing some early wins.
So wrapping this up, we've seen these huge Transformative shifts, big tech's new talent plays, AI completely dominating funding, and software itself evolving, along with these really complex pricing puzzles.
Yeah, it leaves us with a big question, really. For you, for everyone building in tech, how will all these changes keep reshaping things? Talent, money, software design. What does building a successful tech business even look like in, say, the next 2 or 3 years? Definitely something to think about.
Spoken Tech for your ears.